Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 13th, 2023. It is 1:39 a.m. Eastern Time as I'm starting the video. And what I'm going to do in this one is focus primarily on commodities. I want to talk briefly about the market. And again, reiterate unless you've been living in a bubble or you really don't follow this stuff that close, the headlines, the financial headlines. Tomorrow is the FOMC rate decision. The consensus is that they will hold tight, no hike. My thoughts on the market. Again, let me just start there, and then we'll move on to commodities. One would think, common sense would dictate we'd probably get a rally, some type of rally once it's official. Now, again, I don't think that's a big surprise, and it's quite often not what the Fed does, but what the Fed says. However, common sense really hasn't been ruling the roost lately. The fundamentals, the macro does not align with what the stock market's been doing. The stock market itself, is doing one thing, and then a handful of stocks are doing another thing, and that's the big tech, namely, and or anything remotely related to AI. So I've talked many times, and I know many others have, about the very unusual and really unprecedented divergence between just that handful of stocks. That we've seen those similar outperformance leading up to a lot of market tops before. It's usually a bad sign. And lately we've seen that tick up in improvement in market internals, which again was, when I went on before I left on the last vacation down the Keys, I said, go, you're going to have more outperformance on the lower tier stuff. Small cap should outperform, and they have. You can look at that. You can just go to a daily chart here, and here's QQQ versus IWM. I have IWM in green, so that's about right here. First of the month, I put them, they're set to go at the same point. So you can see here, this is IWM. It's over the last couple weeks, as expected, outperformed. The FANGs got too far ahead of themselves. They're very overbought. You still have the divergences. And so, that's you can do a pairs trade or just focus on, where there's more relative value. But then when you roll back, in time, what I'm doing here, and again, they start at the same point, you see that's the stark diversion. So this is what they call a mean reversion trade. You have the NASDAQ 100, big tech, vastly outperforms small caps, and sooner than later, more often than not, you get that mean reversion. The mean reversion can manifest in one of several ways. It can mean small caps up, large caps down, or any combination thereof. In other words, large caps can flatten out while the small caps outperform. Now, going forward, well, I'm going to tell you again. I'll get to the. I'll do the little bit more of a deep dive on the indexes in the next update. I want to cover the semis. I want to talk about that. I really dug down deep into the semis today. And I actually learned something that I suspected, but I confirmed it, and that is the various semiconductor ETFs, which track various semiconductor sectors. There's three of them, three big ones: XSD, SOXX, and what's the other one? SMH. I'll get to that in a second, but there's a kind of a similarity there where you have the NASDAQ 100 versus the S&P, where the NASDAQ 100 is extremely and really almost unnaturally overweighted due to the market cap weighting, and it's really not any more diversified index at all. It's always had an imbalance, and now it's just really almost ridiculous where the top 5 or 6 stocks make up over half of the returns of a 100 stock index. And so I'll get to that in the next one. As far as the charts go, again, FOMC tomorrow. Taking any positions that are dollar sensitive or rate sensitive or have anything to do with the Fed, which is certainly the stock market, gold, silver, currencies, of course, things like that. Well, it's somewhat of a crapshoot. That can go either way. So I just throw that out there. You do what you want. But again, you're going to always have a what I call post FOMC noise. That is the 2 p.m. rate decision, the initial knee-jerk reaction, then the 2:30 press conference where Powell comes on and does his little dog and pony show with the press, and then we'll see what happens there. And then the market decides which way it wants to go. So this is QQQ. Nothing has changed. I sound like a broken record, but what am I going to do? Tell you things have changed when they haven't. The divergences that have been building continue to build. So this most recent high is still a divergent high. This was a divergent high. There was our short sell signal. We popped this morning. They faded to pop, backfilled the gap. You can see this yellow line right here. I think you can pick it up. That's the yesterday's close. So there's your gap. Popped it up, gap backfill. They bought it up, and this was still a divergent and larger. Extended the negative divergences. So, the day I stop using what's worked for many, many years, again, divergences are in a sell signal, but they're high, pretty strong, a likely indication that a trend change is likely, whether it's bullish or bearish. Well, the day, stop using that, I might as well just find another, and there are other tools used, but this to me still indicates that post-Fed, most likely, and you need to get those sell signals. Remember, you have a little trend line here that would need to be taken out. Even bigger and better would be a break of this 357.69-ish, whatever level, because that's 1, 2, 3, 4 tops, 4 levels. So this is all a breakout here. And as I like to say, a breakout's a breakout until unless fails. Support is support until unless taken out. So right now, there's no sell signal. This would be a sell signal. And again, this trade, is well within, I said yesterday, you want to pick a number, I think a 2% stop loss, which would be right up here, really not much above today's highs. I'll measure it for you. We entered right about there, and we're, up about 1.6%. So not much more. And I think it's prudent if you are, short or long, have a stop. And it might get clipped. There's a good chance it's going to get clipped. And when I say clipped, I'm kind of referring to those false, little stop raids. If you post FOMC, let's say you're short, you pop post-Fed and then do this, and then you're going to be kicking yourself. Remember, you can always get back in. That's one thing about stops. It's not the end of the world. You get stopped out. If the chart's confirmed to re-enter, great. Otherwise, it's going to save you some big losses. Likewise, if you're long, this is where, again, I'm just, depending on if and when you shorted or if and when you went long. Let's say you shorted there. I think, stop's not too far above today's highs, around 2% or so. If you're targeting T3, you might be looking for the next leg down, like I still think is a good chance it's coming. And then you're talking 30% plus, 25, 30% plus easy, in my opinion. And then, sure, you can use, short here, you can use a 10% stop loss. That's going to give you a 3-to-1 risk-reward ratio. So it's all up to where you think things are going. But again, charts start to really, a 10% stop loss, if we went up another 10%, especially in the S&P, remember QQQ is not the market. Let me say it again. It's not even related anymore to the stock market. It's a basket of the top 5 largest companies in the world, and they're all tech companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. That's it. And that's all really QQQ represents now. With that being said, now, again, I've showed you in recent weeks that the market, the stock market, even the NASDAQ, the S&P 500, the NASDAQ, the small caps, they're all at typical Fibonacci retracement levels, or Fib retracement levels from the entire bear market bull market top, and which is the start of the bear market in November 2021 for the NASDAQ and most tech sectors, and right around the start of 2022 for the S&P 500. And so we've retraced, again, run-of-the-mill typical retracements, but we're pushing the upper end. So a lot of those are at the 61.8, some are at the 50%. And again, what I'm trying to say is if especially the S&P 500, if it starts to participate, you see a continuation of improvement in market internals, and we go much higher, you start to flip over those long-term trend indicators, and you really struggle to make a case that this is just a bear market rally. So that's why I wouldn't, even if you think there's 30% downside, I don't think it's really makes sense to give it 10% upside, especially on the more diversified indexes. So that's that. There's the your levels. If you're a bull, you want to buy, and you're looking to buy pullbacks. Well, there's a trend line. There's a big support right here. And if you're bearish and you're looking to do short or add to shorts, And same, likewise, bull might want to stop under there, especially under that recent reaction low. And those are levels that have taken out. That's where you can make a case for objective short entries or add-ons. So as of now, we'll keep this one alive. And on that too, depends on the position, the technicals, and a lot of other factors. Quite often, and I've said this in the past, I'll pull stops on a lot of trades leading up to an FOMC announcement. Yes, is that sloppy risk management? Absolutely, but more often than not, you get those noise. You get those initial spikes, and I've said it a million times, and you've seen it almost every time. The initial reaction of the Fed meeting is almost, I've never seen it not faded. I've never seen that initial reaction just keep going. So you get a big pop up. It can be 2-3%, a big follow through. And that's what I call that post FOMC noise. And what it does is it's going to run any nearby stops on whether you're long or short. It's, if they're close by, they're probably going to get clipped. And then, and maybe it saves you a much bigger drop, but quite often it's just going to clip you out, and then the market's going to go maybe the other way. So keep that in mind. Now, on the flip side, I leave sell limit on long trades, sell limit orders in place. And on a stop loss on a short trade, that would be a buy to cover limit order, because the whole goal of any trade is to have your price target hit and not get stopped out, right? So again, that's just me, and again, it depends on a lot of factors. The position, how responsive that individual position is to, let's say, any change in interest rates are real or perceived. Such as gold and silver and the stock market. And then there's other things like wheat and corn that don't give a flip what the Fed's doing. They're going to do their own thing. They're not they're not nearly as correlated. All right, so that's it. There's the 15-minute chart we were looking at. Here's the 60-minute chart, still the big divergence. The daily chart, still have the negative divergence. And that's where we're at, and that's just the cues. And just because I did a little teaser of the semis, I'm just going to show you the semis. So let's just look at that SOX, because as we did before, it's a messy chart here, but I did a clean board for you. And this is the SOX. We do have massive divergence. Now it's holding on by the skin of its teeth, because this is a flat line. The slope on that line is equal, and that is negative divergence. As long as you don't make a higher high, you have equal or lower highs on the indicators. You have a small divergent high there, but just like you had at the lows, you had just a small divergence there that was the catalyst for this whole thing. This to me, and it was on my other busy board, I call it, that's my busy board. That was always, that's why I had it colored up yellow, a massive level. That really kicked off, for all intents and purposes, the bear market. This was the bull market back here in the semis. We boom, 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 boom for a few months, testing that level. We had negative divergence, which again, big divergence on the daily, and that was the, call it the catalyst if you want. Use any terminology you want. At the very least, you can say foreshadowed that 48% drop. And time and time again, we've seen that. So that, and most importantly, that's where you can see support. Finally, when it broke, the semis didn't screw around. They went down hard. That was a double-digit drop. They rallied back 2 days, perfect back test, rejected, tried one more time, and when it became clear, and this is how technical analysis works, that support once broken becomes resistance, and the semis could not regain that level, and they lost their 200-day moving averages and everything. That's where the bear market started. And the traders shorted the pushbacks into the 200 simple or exponential moving average. And then finally, right here, both the 200-day simple and exponential were regained, and that was bullish. And then, since then, again, resistance once broken becomes support. They bought back. They bought the first and only pullback to the 200-day exponential, and then that's brought us back here. So anything is possible. I would be not shocked, but very surprised if, with such extreme overbought conditions, with negative divergences, if we just pop right on through them. And we already tested it once and had a pullback, and we're right on it right now. So you could say, you know what, we got that initial reaction. I'll give it that. But if we fail here again, it's going to be the second failure. And that's going to most likely send the semis, I'll tell you right now. And again, I'm going off on a tangent here. I know I told you I'd cover the commodities. I'll get to that in a second. That'd be a minimum pullback target. So, but I'm going to get into this in another video, and I'm going to show you the breakdown. And that was, by the way, a 13% drop of this ETF and why I've been using that in the past, and then the others, and how this one, really the gist of what I was getting at, this is the QQQ of semiconductor sector ETFs in semiconductor sectors. Stocks. It is extremely overweighted to the top components, namely NVIDIA, as is one of the other ones. And then one of them is much more balanced, a lot like the S&P 500. So I'm going to talk on that. And let's roll right into the commodities. So we're going to start out with a quick look at the euro and dollar. And then I'll kind of maybe start with gold. Gold kind of falls in that commodity category. It's a precious metal. It's an industrial metal. It's not, but you know, a lot of people slap the commodity label on it, so we'll do that here as I covered. So I told you the other day we had a resistance zone right here, and we popped it today. But two things. Number one, we popped it and we have negative divergence. And so far, we're right back on the top of it. But I would put as much weighting on this breakout as far as I can throw it. This is a breakout of a currency, the two biggest currencies in the world, the U.S. dollar and the euro. The U.S. dollar is the dollar index is comprised of 57.6%, I think, of the euro. It's almost all euro. It's by far the largest component. That's why I use this chart, euro against the dollar. And so to take a breakout in front of the Fed is just a wild gamble. It's just a crapshoot. So my point is that breakout could certainly stick, but it also has a chance of failure depending on what Powell comes out and says tomorrow. So anyway, take it with a grain of salt, but watch it. You know, there's the technicals. If it does fail, there's an uptrend line, and that's going to be bearish. We did put in that divergence, but you also had a bigger divergent low there. And so post-Fed, if we continue to rally, we want to see it take out 108, 108.5 right there, and that would carry us up there. That would be bullish for gold and silver. As of now, again, it's pre-Fed, so let's see what happens. And this is what it looks like on just the euro. This is E7 euro futures. There's my resistance zone. Today's breakout. So far, I'm not going to call it a failure because it could be a back test, but I'm also going to say I'm not putting much of a weighting on it, and it did have negative divergence, so that increases the odds that that breakout could fail. As I often say, breakouts that occur with negative divergence have a much higher failure rate. Why am I talking about this once again? Because there is an unmistakable, extremely high correlation between gold, silver, and the US dollar and the euro. In other words, gold and silver go up and down with the euro. They're positively correlated, and they're inversely correlated to the dollar, and that's only because the dollar index, remember, is simply what the dollar is worth relative to its peers, and because the euro is by far, you know, nearly 2/3 of the dollar index, it's just opposite the dollar. That's all it is. This goes up, the dollar goes down, and that's that. And so you can see there's silver and dollar, you know, euro popped today and then faded. And so silver's down, but it already hit that target right there. That's pretty good resistance. There's one more target upside. There's more upside if again, depending which way the dollar breaks. I just wouldn't bet it too hard going into the Fed. That's all, and we can pick it up later. Here's gold. Maybe tweak this trend line here on the 60-minute chart. It looks a little sloppy. Let's put it like that. Still have really good support here, about 179.85, and the divergence, should gold pop down through there, I'd be careful about shorting it, and you might want to give it a little room if long, because we had divergence here, and so far we have these, you know, pretty much 3 equal lows and any marginal new low, as long as it's just marginal, and then you reverse. You know, if you break it and go down to that next support level there, you're going to take out the divergence, and then it's not as strong a case to be long gold, silver, GDX. And again, when I speak of this, it's collectively, you know, to be bullish gold is to be bullish silver for the most part. Sometimes the charts are telling me one's going to go up and the other's not. Same with GDX, but for the most part, they all move together. So there's your update on gold, silver. Already did the markets. Now I'm just going to rifle through commodities for you. Okay, so from a both technical and fundamental perspective, I've made it very clear for a couple of years now. It's my opinion that commodities, not even an opinion, I'm sorry, it's fact that commodities ended a great bear market. That bear market started back in 2008 during the last financial crisis. Commodities rose and were doing well. Remember, the stock market peaked right here in October 2007, and then there was this blow off top in commodities, particularly oil running up to 150 a barrel, and that really ramped commodities, especially the broad-based commodity index. And then you had an unmistakable bear market, series of lower lows, downtrend line, everything. A downtrend is defined as a security making lower lows and lower highs, and that's what happened. Then when COVID hit, we had a final washout selling climax, if you will, where the bottom just fell out of commodities because it doesn't matter, but everyone thought the world was coming to an end. They did shut down the world, global economy for a bit there, and then pick back up. But it doesn't matter from a technical perspective, and of course fundamental. All the money printing, there was never a stronger case to be long and bullish commodities, and we were, and then nothing goes up forever. So all the primary downtrend line, that's number one, was taken out. And then all these previous reaction highs. And again, that is the definition of an uptrend, security making higher highs and higher lows. And it is still my opinion, there's no guarantees, that that was the first leg up in a new, larger bull market in commodities with more to come. So how will we know that's going to be the case? Well, let's look at DJP. DJP, like every commodity, all the broad-based commodity indexes out there, most of them have the highest weighting or very high weighting in energy. This one is one of the more balanced, but it's still about 40% energy. So just keep that in mind. With commodities, ideally you want to be selective. Sometimes soybeans are going up and wheat's going down, or those are grains. I'll pick a better example. Copper's going up and wheat's going down. So there's almost zero correlation between a lot of the different commodities. Some have a higher correlation, but from a technical perspective, let's just talk that. There you go. And from a fundamental perspective, first of all, from a technical perspective, we were extremely overbought here at the highs, right? And we had clear negative divergence. All pointed out at the time. We had a breakdown there, a sell signal. We shorted oil at the top, got in right there, rode that first leg down, caught that. And this is, again, what I view as a correction. So far, it has all the makings of corrective action, price action, a longer-term bull market. I will say one of the things you want to see going forward, if that's correct, you want to see these 200-day moving averages recovered here. See, we entered the new bull market here. Well, the bottom there, COVID, took out the 200s, back tested them, and they've acted as support, okay? And then we took them out here, and we're riding below them now. So number one, it would increase the odds that this was corrective action and there's going to be another major leg up if and when those are taken out, right? That's number one. Number two, you can see I have a downtrend line here. I'm going to draw it for you so it's a little more clean. This is the best fit I can get right now in a downtrend line. If you come off the highs, it's not as clear, so that's the one I'm liking, or you can put it like that. So either way, see, they all come in together. So this is the big area. So in the coming weeks to months, be on the lookout for a breakout above there, because that should be a longer term, more powerful buy signal, and show that we're most likely, in the early stages of the next leg up. That'll probably take commodities to at minimum test that previous high and quite likely take it out. And this is a big and. This is fundamental macro stuff too. If that happens, that's going to be the return of the inflation trade. A lot can go on. I'm not married to that at all. We could certainly see continued deflation. We've seen an abatement in the rate of inflation. The numbers came out today. Month over month it was very low. However, year over year, we're still running twice what the Fed's target is, 4%. And that's government's numbers, which nobody trusts. We all know inflation was a lot higher in reality than what the CPI reported. But either way, there's a nice clean trend line, and we're right there. We could break out at any point. Big positive divergence says, that's likely going to be the catalyst for next major trend up, not just a quick swing trade. And we did have a false breakout. I've been looking for pointing out these divergent lows for a while. We keep ticking lower and lower, but watch to see if this trend line breaks out. And we'll watch some of the individual commodities, which I'll get to in a second. One more thing to just support the case that this is most likely corrective action. You might say, oh no, the inflation trade's over. Well, we dropped 30%, right? But that's also after a gain on DJP of 167%. And here's your old friendly fibs, right? Fibonacci retracement levels, a typical counter trend move will retrace anywhere from the 38.2% Fibonacci retracement, 50, all the way down to the 61.8. So we really reversed right about, we're a hair above the 50 so far. So from that perspective, it is just a run-of-the-mill, typical corrective price action so far. When does that start to change? You continue down, you take out key supports, you take out, the 61.8 fib, and things start, it starts to become a little harder to make the case for another leg up, and especially if the divergences are taken out. So that's your big picture on the commodities. Now let's look at some of the individual ones. I'm going to talk about a change in your options now. If you are, I get the fewest comments on the commodity trade, so I want to throw this out there now. As I go through these, I'm going to show you over a dozen of popular commodity ETNs were recently redeemed by the issuer, iPath. iPath is one of, I believe, the biggest issuer of commodity ETNs. So for those of you that don't trade futures, but do believe that commodities, if nothing else, offer diversification in your portfolio, asset allocation, all those important things that you should incorporate, well, guess what? A lot of your choices have just been eliminated if you only trade ETFs and ETNs and you don't have a futures account, because iPath pulled them in. I read there, and I'll show it to you in a second. Oh, let me do that now. Let me show you which ones are gone. Okay, here it is. Barclays. They're the ones that make those iPath ETNs, so many of which I've covered hundreds, not thousands of times over the years as trade ideas, especially both for using the charts and for those that don't trade futures. And so they redeem these. You can do a little digging. Maybe it was in the headlines. I never caught the reason why. But remember, a couple months back, we've had just in the last few months, we've had 3 of the 4 largest bank failures in the U.S. history of the financial markets in the U.S. These, the difference of an ETN, very important. I talked about this when there was a lot of stress on the regional banks. A lot of concern is that ETNs are not ETFs. They're both exchange traded products, but there's a big difference. An ETN is an IOU, a promise from an issuer, which is usually a bank, that, hey, we'll make you, we're going to track it. They do use derivatives, and they do track well when they're working well. But if the bank blows up, then guess what? You're SOL. There's, you don't have, they were using derivatives. They don't have the money in sugar. They have, derivatives, sugar futures and all that. And if they blow up, and it happened with some of the VIX ETNs a few years ago. You got nada. Now, they didn't blow up. They retired them, and they, in the press release, you can read it, Google it. They said they're just going to cash them all out on at face value on the redemption date. And they always have ETN issuers in the fine print always have the ability or the option to redeem those ETNs at their discretion. And so, my guess, it had something to do with the stresses on the banking system, because it's pretty much a coincidence they just retired them. But look at them all. Oil, which is a crude ETN I've covered many times in the past. Cocoa, gone now, and I don't believe there's another one. If you hear of one that's out there, let me know. But as of now, this is the one I've used and charted and shared as trade idea for years. Gone, no longer trading. It was a natural gas ETN, lead, copper index, coffee, JO, that was a big one. JJG, it was a nice, I always pitched that as a one size fits all if you wanted to, because the grains tend to move together, and those are the 3 in there were soybeans, wheat, and corn, wheat, and soybeans. Gone. That was the only one like it that I'm aware of. Cotton, BAL, gone. Sugar, SGG, gone. Now there is cane. It's another issuer. I'll get to that in a second. So you can see them all here. Cow. There was, if you wanted to play lean hogs and live cattle, they were both in that one, gone. So you can see it's quite a bit of popular ETNs. And again, many of these do not have, to the best of my knowledge, some do, but most don't have any other alternatives. So your only way now to, let's say if it's cocoa, unless I'm wrong, you find another ETN or ETF out there, let me know, but you got to play cocoa futures. Alrighty, so let's rifle through these individually in no particular order. I have a watch list I'm just clicking on off the screen of all my commodity ETFs and ETNs. And so recently I mentioned, put on wheat as a trade idea. As I said a minute ago, corn and wheat move together. They're both grown in temperate climates. Similar climates, they're both alternative, can be substituted when the price is high on one. You can, make bread out of wheat. You can make bread out of corn grain. You can feed your livestock, either one. So they tend to move together. And it's a little bit busy, but I'm just going to highlight here. We had a little divergent low there. I guess must have given just one price target. It was hit, but we have a much larger divergent low now. There was that small divergent low. Big positive, aka bullish divergence. And what I didn't speak to a minute ago when I was on DJP talking about the whole first leg up overall in commodities, the inflation trade, what Powell completely missed and the entire Fed missed, and then we knew inflation was real. There's also a macro case to be made that the Fed, Powell, when it was hard for him to do because he's a dove by nature. Most of those folks are on the Fed, and of course he's the boss man. It was not in his nature, but he turned into a hawk, and he remains a hawk, at least more so in rhetoric now, because he's probably going to pause the interest rates where they're at for now. But where I'm going is, it makes sense that we had technically, again, first and foremost, technically the case was made. It was a hell of a run. Nothing goes up forever. They needed to correct, and they did. And that was also reflected in the largest interest rate hikes in history. So it makes sense that, they did, put the brakes on inflation, at least, based on commodities. That completely makes sense fundamentally as well as technically. Now, let's say we have the Fed start to pivot. We already know they're going to hike. Not hike. And so that in itself is a pivot. You're changing from a hawkish Fed that's been hiking at all the meetings for a while now, taking rates up, to now stopping. And then quite a few people, and even I believe the interest rate futures predict that he will start to cut as the recession finally starts to manifest in the second quarter, third quarter this year. Fourth quarter, we'll see. And so that would be a fundamental reason for return to the inflation trade. And I think I'm seeing a lift lately. I think a lot of the hedge funds and smart money is starting to get ahead of that. We're seeing, coming off that divergent low, a pretty good rally. We've had some false starts so far, and they've been short-term swing trades, but if we can get some traction, bottom line is there's your downtrend line. It's pretty clean on corn. If that gets taken out based on the scope of the divergences, corn would most likely, it'll probably hiccup along the way. I'll have to change some targets, but it'll most likely run at and quite possibly ultimately take out those previous highs. So let me just say this. I'm doing this video because I like these ag commodities now, if nothing else, especially for a long-term investor, 401k type money, IRAs. It's certainly, you should always use asset allocation. I use tactical asset allocation. I don't sit on a 60-40 bond stock model or 10% commodities or whatever it is just because, that's asset allocation. No, I will tactically and strategically move in and out of those. If it tells me to be short commodities, the 10% or 20% or whatever my portfolio is going to be mostly short commodities, if the charts say so. But with that being said, right now I think the risk reward is certainly favorable, and it's to me infinitely more favorable than big tech right now. In other words, if you put a gun to my head, said, Randy, you got to put all your money in either broad-based commodity index or QQQ for the next 6 months to a year, Oh yeah, commodities all day long. So that's my take based on everything I've just been talking about. All right, palladium. And again, these are no particular order. I didn't sort them, so I'll go back. We're going to jump from one grain to another and then over to metal. Palladium looking pretty good here on the daily time frame. Guys, if I forget to mention, unless I say otherwise, you can see my time frames up here, PAL daily. You can also see a little D, that's what I'm on. Sometimes I might jump to a weekly. Positive divergence. This is simple stuff, really. Not at the risk of oversimplifying it. You had a divergent high right here, negative divergence. You had a drop. Now you have positive divergence. You probably get a rally. You had positive divergence, just like that, same divergence, same scope of divergence, everything right there, and you had a big rally. And palladium or platinum here, the runs are, up and down are big. It was a 104% run there. That rip, if you shorted that divergent high or anytime thereafter, you caught a good part or all of that 45% drop. So I see no reason that if those divergences play out, the palladium will not run to at least this 166 level. That would be I'll give you a first target would be about right here-ish. I'll have to zero in on that. I'll have to look at the futures as well. This is an ETF. By the way, it's an ETF, not an ETN. This holds physical palladium. So it's, in theory, I'm not going to make any promises because I can't, but it's technically a whole lot safer than an ETN. About 30% upside if that 166 is hit. Moving on, soybeans. Soybeans at the downtrend line right now. Coming off, we have RSI divergence right here, meaning that we don't have PPO divergence, but sometimes it only takes one or the other, and that's what we have. So divergent low, there's a downtrend line. If we do get rejected, maybe we go on to put in a divergent low here. You don't have to have it, remember. Divergences, although they are an indication that a trend change is likely, they are far from an absolute necessity. A lot of stocks top on or indexes or sectors, commodities, top or bottom without divergences, but it is a common trait at the big tops and bottoms. Okay, you can see it on my chart. So that's what we have there. At resistance. So here's the thing. I would not buy this one right now. You don't want to, if anything, you short it because this is a rally into dual resistance, downtrend line resistance, plus very, very good price resistance. However, a breakout above that level is quite bullish and should send soybeans up. So, you'd want to maybe set a price alert and watch that one. That's a setup. And if it pulls back, then maybe we'll look to buy it down on support or something like that. Moo. This is an ETF, and it does not hold any commodities. I want to be clear on that. It sounds like, but agribusiness are companies that benefit from agriculture. They'll sell products and services. John Deere, for example, you have your harvesters and farm equipment, all that. Those are the components and things like that in there. Archer Daniels Midland, those type companies, Tyson, chicken and all that, pork and all those products. Big positive divergence on the RSI, but not on the PPO. I'm sorry, on the PPO divergence. RSI is extremely oversold. Last time we were oversold was right here when COVID hit. So there's the case right there. And if you're bullish on the stock market, then that's good because remember, these are stocks. These companies can fall in a hard correction or bear market. They will almost certainly fall, even if agricultural commodities are going up. Because remember, they don't hold wheat and corn. The prices of corn and wheat can be going up due to scarcity, but that doesn't mean they're going to sell more John Deere harvesters, necessarily. So, and stocks tend to get sold down because they're indexed as well. However, I like this. So, and if you're bullish on the stock market, then how can you not be bullish on this? Your buy signal comes on a break of the downtrend line, of course. And then targets, well, I don't have any right now. Like I said, I've gone through a lot of these charts to update, but not all of them. Wheat, I covered that the other day, threw it as a trade idea here recently. We made a marginal and slightly new, but still divergent low. Big positive divergences right at the downtrend line right now. So what it looks like here is post-Fed. If the smart money believes, or forget about we won't know what the smart money believes. Let's look at the charts. If you break out, a breakout's a buy signal. You buy it, you go long. If it fails, no big deal. You have your stops wherever you want them if the breakout fails somewhat below. But this, tells me There's a big divergent low in wheat, and we could easily see another major leg up. So one of my favorites, and of course it's an active trade now. Wood, it doesn't hold wood or lumber. It holds companies, timber and forestry companies. It's in a trading range. I don't have a strong opinion on this one, so I'm going to move on. Cane is a sugar ETN, the only one now that I know of, because SGG, as I showed you, just got redeemed by the issuer. You had a little divergent high here, and you start to pull back, so you have support here. Small divergent high, and you can see I drew some lines that say, look, we could thrust one more time up. This is, I wouldn't, it's too overbought, up too much, and any new marginal new high is going to be a divergent high. That's why I drew the lines this way. So this one to me, I'd be waiting for a break right here of that 1322 and uptrend line, and that would be a short. Remember, wheat and other grains have been falling, sugar's been going up, so this is a great example that even within the ag arena, that's why if you invest in a general broad-based commodity ETF, you're just holding, it's like investing in the S&P 500, or almost worse, because you have so many different commodities that have nothing to do with each other, and so if some are ripping at the same time, you have others that are falling, and it's really just muddling or diluting the returns of that ETF if it's broad-based commodity. That's why I like to be selective on these. That's why I do these long-winded videos, to show you which ones stand out as attractive long or short trades. So that one's more of a short setup. UNG, I've covered it quite a bit lately. One of my favorites right now. Huge, big divergences building. It looks to be, and the rate of descent, as I told you, has slowed. It was in free fall here. We had these divergent highs pointed out. We were short up there. It's admittedly tried to catch a couple bottoms on the way down, got some cuts, but overall, natural gas has treated me very well in the last few years. It's trades very well to the technicals normally. A lot just like the stock market, divergences have been not being ignored, just extending, getting bigger and bigger and bigger. So just like I think, there'll be the divergences will ultimately and sooner than later play out in the stock market and other things. I think they'll play out here as well. And this will be the return of the inflation trade. Now, you might say it does contradict with my outlook and many others that there is a recession coming. It's just a slow roll. I was adamant from before this bear market started, many times thereafter. I said my view is probably different from almost everybody else's out there. I think a lot of people are looking back to 2007 to 2009 and 2000 to 2002, which were our last two true bear markets, and the average on those was less than 2 years. I think this one's going to be a much longer, slower roll, and play out that way. So we'll finally get another leg down ultimately in the equity markets, and what'll happen, it'll coincide most likely with the slowdown. The interest rates, when rates are changed, lowered or especially raised, they say there's about a 12 to 18 month lag time before the effects are felt in the economy. So that's coming up soon. We'll see. Can't see how it won't play out. If you read all that's out there, commercial lending, all these loans coming due in the next year or two that are going to be refinancing from 3% to 7%. Oh, it's crazy. Either way, that would be a return of the inflation trade if we start to see things like natural gas, crude oil, agricultural commodities all start going up. And what I was getting at is, yes, you can have, typically slowing economic growth will bring commodity prices down, but not always. And the only thing worse really than inflation is deflation. Stagflation, where the economy shrinks or is stagnant or goes down, and commodity prices go up. You still have inflation, and that's really that's the worst case scenario for the stock market. JJG, as I told you, grain ETF's gone. So let's, it just, you can see when you zoom in a chart and you see these little lines like this, tick, 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 that means it's no longer trading, right? When you see the candles flatten out like that. So that one's gone, but you can see up until it just recently was redeemed, and you had a big divergent low. And remember, this is the one I told you has corn, wheat, and soybeans, but unfortunately you can't buy it anymore. DBA, my one size fits all for agricultural, ag commodities. So if you do want to play the ag commodity arena, you don't have the time, inclination, skill set to micromanage a portfolio of individual commodities, then this is your one size fits all. I haven't updated it in a couple years, but it's not going to change. You have a little of everything: live cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, cattle, cotton. And you can see this is, and this is important too, it's showing you that food inflation is not abating at the rate oil and energy and everything else did. This was the big level right here, just like in the beginning of the video on the semis. I showed you they put in a divergent high, right? And then had major resistance. It's at that level, and you can make the same case. Maybe you get rejected here. Again, my view is we'll probably get another surge in commodity prices. So I can tell you, don't buy it here. If anything, you short it. You short a rally into resistance, or you wait. If you're bullish, wait for a breakout. And as long as that breakout sticks, great, you're good. You're probably going to run at new highs and break them. And if the breakout fails, well, that's where you stop out. Anywhere there, you can give it a little room. Sometimes you break out and they, the powers that be want to run it back in, shake out the weekended longs and then run it up. So you don't have your stop right under 2135. You have it down maybe below this 2033, especially if you're targeting a move way up there. It's all about, and then this is ugly time if it breaks this big support zone right here. So this is the story of food right here, or agricultural commodities. They've been in a trading range. They topped here. This was by every metric, new early stage bull market action. By every other metric, this is just corrective action here. You take Fibonacci retracement and tell you that you do it this way. Start from the bottom. There's where we bottom. That initial leg up, and we retrace to the button. I hadn't done this before. Never fails to amaze me. Perfect 38.2% retracement. All right, that is a typical counter trend rally where we've regained those 200-day moving averages. So this is kind of painting the picture again of what we're looking at with ag commodity prices, inflation, everything else. But again, you need to get that breakout, and trading range and resistance is resistance unless broken. So bulls win, bears win. Until then, it's trading range. If you want to trade it, take a shot here. If you want to short and go down to the bottom, based on these positive divergences we just put in, I would favor and wait for a breakout than trying to short something that just put in a big divergent low recently. JJU gone, aluminum. JJC copper gone, coal gone a while ago. They're redeemed. I just keep it up to remind myself to look at the coal stocks every now and then. BAL cotton gone. I threw it out as a trade idea recently. We hit my first target and still waiting on the second, third, and fourth. But you'll have to trade futures. Cotton futures if you want to, unless again if you find a cotton ETF out there, ETN, let me know and I'll start to cover it. NIB cocoa gone, redeemed. Cocoa is looking ripe for a short. Remember, these just got redeemed recently. Big negative divergence, so cocoa is on my radar for a short trade, and it can go also here. Let me show you something. You can look at cocoa futures, cocoa right here. Negative divergence. Let me try to circle everything, change that color. Divergent high right there. Again, divergence is not a sell signal. It's an indication a trend change is likely. So if the divergence starts to play out, your first target would be a pullback to the uptrend line. If and when that uptrend line is broken, probably get a correction. Where does that correction go? My money would be on a pullback. Ultimately, probably to this. Oh, that's not my arrow tool. To this primary uptrend line right here. Here's your bull market uptrend line right there. Quite the drop. We don't have to get all the way there. There's plenty of support levels along the way, but that would be the max drop. And at that point, I'd be looking to go long, cover any shorts if I'm still short cocoa at the time. So I'll be looking a lot again and starting to share more of these futures charts. But again, it's by feedback. If I don't get a lot of feedback, everybody's quick to jump all over in the semiconductors or the index trades, and I get it. My job is to provide what you guys want to see and trade. So where I'm going is, if you do trade futures or you're interested, let me know. Otherwise, I'm not going to do a lot of coverage on charts if people aren't taking advantage of trading those. Okay, long video, almost done. I'm just clicking through these. Sugar gone, SGG. Remember, you can still trade Kane, CANE. Joe, Joe was retired. I didn't write it down here yet. Been trading this one for years. It used to be Joe back in 2007, 8, 9. And at some point they retired that one, and that's still traded over the counter. JJOFF, I think, something like that. And but those over-the-counter ones are very thinly traded. I'm not going to share those. So what they did is they retired some of those old ones, and then came out with a new version, and now this one too. Again, iPath, they just decided to pull the plug on like most of their ETNs, not all of them, but most. And again, I imagine that had something to do with the banking crisis. Cow gone, COW as I mentioned, so we're not going to cover that. But I will cover lean hogs and live cattle when I see opportunities. The futures, JJS gone. That was a soft commodity ETN. Gold, of course, is still gold. I already covered that for you earlier. That's support. And again, I covered that in the beginning. CUT is just another timber and forestry ETF that holds those companies. There's a downtrend line. It's in a bear market. Not much to say about it right now, other than it did just put in a divergent low. So if anything, would I buy it just based on that? Well, it'd have to pop this. If it can pop, 30.27 and these 200 days, and then that downtrend, each of those would be incremental buy signals. Swing it up to at least 33 right there. Copper, CPER. That one looks like it's still trading. I think it tracks the copper index of copper companies, if I'm not mistaken. DJP, I already covered that. And that's one of my, that's my kind of my inflation gauge. This, and I've showed you this many times. I've gone over those other boards I had that show you, this is it. You can predict the CPI with almost, a high degree of accuracy by just looking at this and say, okay, what was inflation? So we just came off. What did they just report? Would have been the May data. So surprise that inflation, numbers came in cool month over month. There's the drop in the month of May right there, right? You can see start of the month, end of the month. So just keep an eye on this, because if this starts to go up again, then the Fed has problems. They won't be able to. It's going to make it harder to hold rates tight or to cut rates. GCC is simply another broad-based commodity ETF right there, and positive divergence, as you can see, right? And PPLT I highlighted recently. Platinum took out that support there, but still has that positive divergence, just not behaving well lately. You want to see it take back. I'd have to get to the futures chart, and I'm going too long in this video. I'll update that one later. I think I just updated it yesterday. GSG, another broad-based commodity ETF, positive divergence, divergent low, still holding that divergent low, making equal lows there, and that'd be your best downtrend line. So it's going to look similar to the other ones I showed you. LD, no longer trading. It's been retired, and that was led. OLK, crude K1 free, crude ETF. Crude's looking good too. Here we go. USO. So USO, positive divergence recently on the 60. It looks pretty good. Not so much here, but on futures. Let me get you that. Okay, remember the ETNs, the commodity tracking ETNs and ETFs, what they're doing is they're buying the futures. So the futures are the pure play. There's a downtrend line on CL crude futures. There's their positive divergence. This is the first time, remember, for a while, I keep telling you I'm not updating crude because it's just been in a big sloppy trading range. I haven't seen any objective long entries, short entries. This is the first time in a while I see some nice, clean, positive divergences on the 60-minute chart. Your little minor downtrend line. So this will probably be the catalyst to take us up. Check that downtrend line again if we break out, and watch it. I don't have the highest degree of confidence, but it is, if nothing else, something to watch, because the more you see commodities, inflation, especially the ones that have the biggest impact, energy, crude, natural gas, that's going to again be a problem for the Fed and a problem for the stock market. Stock market's been cheering, rallying up to this, expected pause from the Fed, and so, return of inflation would certainly be a thorn in the side for the stock market and the Fed. And last but not least in this mega video, my apologies, I probably shouldn't even talked on the stock market in the beginning. I just kind of wanted to get that out there. This is a box here, a very well-defined trading range, and within there, so yeah, you can see it. This is gasoline, unleaded gasoline, going in a sideways range. The only trade to be made here, if you're an active trader, just use these little minor trend lines. Short the high of the channel. That's an MO, and it's cover at the bottom. You also have, you could put a box here. Lately, that's been holding. This is where we've been falling to. So it's a game of ping pong. You have these little trend lines. They break. They give you sell signals. The downtrend lines break. They give you buy signals. And but ultimately, what you need to see, and again, this is going to have an impact on the market. Bullish, a solid upside breakout that holds and sticks, and bearish to see a downside breakout. With the indicators flattening out in the trading range, I don't have a strong opinion. Again, more of something to watch. Trade it if you want, but I'm sharing it more of a, just this is going to have a big impact on, or could, on both the interest rates as well as the stock market. All right, guys, I'm going to wrap it up here, get the video out to you, and I'm going to continue to hunt for trade ideas. And probably later today, I'll do that video, if not tomorrow, on the semiconductor stocks. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.